All right. Here we are. We're ready to go. This is the morning bell. We got a couple minutes to go before we're going to get rocking and rolling here. But what we've got here on the chart is the S&P 500, the Dow, the mini Dow, the Nasdaq, and the Russell. And we're going to be watching the opening bell here in the futures market. And glad you're with me. Let's see what's going on. You can see that what I've done here so far is I've just got these four charts on the screen. And I've drawn the dollar calculator on here so you can see just kind of the scale of what's going on. So this is the S&P 500, and from the top of that last drive to the bottom, that was about a $300 move. Here on the Dow, that same drive was about a $160 move. Here on the Nasdaq, it was about a $400 move, maybe a little more. Yeah, about $400. And then here on the Russell, that last little drive was about $145. So you can see that they're all kind of a little bit different, but our two bigger markets are the S&P and the Nasdaq. Our two smaller markets are the Dow and the Russell. So yesterday the Russell was actually doing the best. It was making the best trends. And I like to watch all four in the morning bell because I like to watch and see if they all sync up, because they should all basically, if you can look, the patterns are almost exactly the same. So yesterday what happened is we ended up having markets that they were diverging, they weren't converging. So we had divergence and convergence between the price of the four different indexes. And that made it hard to trade because usually they follow each other, and usually we have a leader, and usually it's the Nasdaq. So the Nasdaq will take off and go, and then the S&P will follow, and then the Dow will follow, and then the Russell will follow. It doesn't always go in that order. Sometimes there's a leader, but then there's always, not always, there's usually a lagger, and he takes off later than all the rest. And so that's the one you want to trade. You want to sit here and watch, wait for the signals, wait for the setups. We're going to look for little ABC patterns. But then you wait for that pattern to occur, and then you watch one go, you watch the other one go, you watch the other one go, you trade the slowest one. And then he usually follows. And then if these start to die, then this one will probably start to die too. So you can see it kind of gives you a little foreshadowing what's going to happen in different markets. Kind of a little trick you can use when you're trading the four indexes. And we got the morning bell going to start here. We got what, 43 seconds until the bell goes. How do I know that? Because I have a clock on my computer that tells me at 7:29 a.m. And then up here you can see in the Dow, the top, I've got 33-second countdown. So there's 30 seconds until the bell. And then that's the opening bell. Now we're in the futures market. So the futures market trades 23 hours a day. It only closes for 1 hour. So it's been trading all night. And the opening bell is actually in the stock market over in New York. So these are indexes that are highly traded on the New York. Over in the New York, it would be the DIA. We would have and the S&P would be SPY, and the Nasdaq, that would be your Qs. So those markets will open at 7:30 in New York. So the opening bell is really kind of a misnomer in the futures market because we've been trading since yesterday. Market closed yesterday 3 o'clock, right? So and then it opened back up at 4. So what we've got going now is we're just watching New York open over here in the futures market. So these markets are traded in both places, and we trade them over here in Chicago, in the Chicago markets. And the reason we like to trade them in Chicago, here I'll throw up a little banner comment for you. Here's a banner, show you why we trade the futures market. We're trading futures to the Chicago Mercantile Exchange. This is not the New York Stock Exchange. All right. For those of you who don't know, futures are traded out of Chicago. And trading through Chicago, there are no pattern trading rules. You know that over in New York, you have to have $25,000 in your account to day trade. And then if you go one penny below 25,000, they shut you down. You can't do it. So you have to have actually like $30,000 to have a $5,000 buffer to day trade in the stock market. You don't have to have that over here in the futures market. You can open your account with $5,000 and away you go and trade all you want. No pattern day trading rules. Look at the Russell. Holy cow, that thing dropped. Gave us a false look. The Nasdaq gave us a false break to the upside. So everybody who went long is now crying the blues because they thought, oh, we're going to go long as soon as that market opens. Look at that nice big green bar, but look at the Russell. The Russell tanking. And remember, the Russell 2000 is 2,000 of the kind of the small cap stocks The S&P 500 is the 500, what they consider to be the best stocks in the stock market. The Dow is the best 30, and then the Nasdaq 100 is the best 100 on the Nasdaq exchange, because we have the two exchanges out of New York, right? We have Nasdaq and we have the Chicago, or excuse me, we have Nasdaq and we have the New York Stock Exchange. So those are your two exchanges out of New York. And then of course we have the exchanges out of Chicago. The primary exchanges out of Chicago are the Mercantile Exchange and the Board of Trade. So we're trading these. These are in the Mercantile Exchange, the Chicago Merc. And there's no pattern day trading rules over here. If you want to open up an account, $5,000, and come and trade like this, a lot of fun. So if you want to do that, all you need to do is just get a trading platform. So the trading platform, of course, I'm using is Track and Trade. My trading platform is Track and Trade Live Futures. So go get that over at www.trackandtrade.com. Install the trial. You get that for free for 2 weeks, and it's got live streaming quotes. It's not delayed. And so you can go get that, and you can come and watch along with me and follow along and do what I'm doing, and I'll show you how I set up my charts. If you want to make some comments, I'll watch the comment list here. It'd be nice to have everybody write something in the comments, say hello, let me know you're here, and so I can talk to you. If you have questions, I want to answer your questions. We're going to kind of watch this market. I want to see it play out here for the first few minutes, see what it does. We've got the big three, the S&P, the Dow, and the Nasdaq, all trying to rally this morning. But the Russell, man alive, it's dropping like a rock. Let's get this this dollar calculator off the screen here. Clean things up a little bit. Now I'm using, just so you know, so I'm using, these are all 1 minute charts. So these are all 1 minute charts, and we're just watching the market bounce around here in the morning session, which is usually what it does. It kind of rocks and rolls around a little bit. It's difficult to trade. So we kind of let this one set aside. What I've got going is I've got, let's clean this up too. Let's go ahead and we'll delete all the crosshairs on here. But I've got the VWAP. This is a volume weighted average price. Now, the only reason that's important is because other people think it's important. So that's really, when it comes to technical analysis, the only reason technical analysis is important is because other people think it's important. So lots of traders use technical analysis to help them make their trading decisions. I use technical analysis all the time. That's what we do. That's how we trade. It's the fundamentals that drive the long-term trends. So that's why we pay close attention to things like the news and find out what's going to go on in the news. And well, of course, you know, if you're trading individual stocks and things like that, you want to know what the fundamentals are of the individual stocks. And of course, when we go in and we start trading things like corn and wheat, soybeans, crude oil, natural gas, gold, silver, you know, all those fun things, we of course want to know what the fundamentals are on those too, because the fundamentals are very important. Those are what drives the long-term trends. But what the technicals tell us is when to enter those fundamentals, right? When do you get in? Oh, gold should go up. Why? Oh, I heard some guy on YouTube say he did this big long thing, said gold should rise, and I want to get into gold. Okay, great. When? Today? Is today the day to get into gold? Or tomorrow might be better. Oh, what about 5 minutes ago, or maybe in 10 minutes it'll be better? So that's what technical analysis does. Technical analysis helps us know the setups and triggers for entry to the longer term trends that have been determined by the fundamentals. If you have a bad information come out, then you would want to take a short position. But when do you take the short position? When's the best timing? That's what technical analysis is all about. Technical analysis is about taking that short position at the right time. Okay, so it's all timing. That's why we use technical analysis. That's why it's important, because that's what most traders do. Even large institutional firms will use technical analysis to some degree to help them get into these big markets. So they use timing for entry. And so today we've got a couple of reports coming out. 7 a.m. this morning, we had the S&P Schiller home prices and the SPK Schiller home price year over year. So previously it was 1.5, the actual is 0.9, the previous was negative 1.7, and it's 1.2. So it actually went up just a tick. So that was a little bit of positive news, not much, it's still negative, but it's better than it was last time, right? Last time they reported. Now the big one is that 8 o'clock, we have the JOLTS job openings. So that's 9.582 million, and we're going to wait and see if that's higher or lower. And at 8 o'clock, when that news comes out, it'll move the market. That'll be good fundamental news or bad fundamental news, and we'll have to watch and see how that affects the market. And then we'll look for setups and triggers. We'll look for a breaking of a trend line. We're looking for, if it's good news, we'll look for a setup, a technical trigger for entry to the long side. If it's bad news, we'll look for a technical entry to the short side. But just because it's good news doesn't mean we jump in. Just because it's bad news doesn't mean we jump in. Because sometimes these markets get this news and one guy will see it as good news, one guy will see it as bad news, and the market just sits there and does this until the majority of the people decide whether that was good news or bad news, and then the market starts to move. So we just going to wait until 8 o'clock because we have an important news event coming. All right, so looks like over here, looking at the Nasdaq started to rally nice and hard. Now this is a little buy signal right here. This is a little buy signal. As you can see, what's happening as we got this 1, 2, 3, 4 bars, and you'll notice I'm using Fibonacci bars. Fibonacci bars, I can turn those off. Watch this. I'll hit this, and this is what most traders are seeing. Take off the indicator. This is just the average true range, the yellow arrows. They're just telling you when the market's changing from bullish to bearish based on the average true range. I've got the average true range set to 1. So it works better at this setting if you're using the Fibonacci bars. But this is the normal candlestick bars. And you can see that the market's rallying up, green, nice big green bars. We're getting a little pullback, red pullback. But we look for an ABC pattern. So the ABC pattern is, up, pull back, and up again. So we want that second reflection or the push higher. So we wait for the first push. We don't get into that one. And if it takes off and goes to the moon, we miss it and we feel bad. But we're waiting for the ABC reflection. So if I turn those Fibonacci's back on, it kind of shows you where that's at. So this market's coming up. It's pulling back down. And this is on the Nasdaq. This is the pattern we're getting. We're getting it over here on the S&P a little bit here too, but it's not quite as strong. So this should turn around, come back down. It's going to hit that blue line, which is the VWAP. And again, the VWAP is the volume weighted average price, acts like a rubber band. So what it does is it pulls the market back to that blue line if it's above, and if it's below, it'll pull the market back up to that blue line if it's below. Just think of the VWAP as a rubber band. Okay, it pulls the market towards that blue line. Okay, up here on the Dow, we're starting to rally. We're coming a little higher. As we pull back against this thing on the Nasdaq, we got 20 minutes until our report. And sometimes, it's a little nerve-wracking to trade before a report like that. A lot of guys will anticipate the report's going to be bullish or bearish, and so they'll try to get in early. But usually you want to wait till the report comes out, wait for it to settle down, see what it's going to do, and then you can start trading the patterns going one direction or the other. So I'm going to be bullish down here on the Nasdaq. It's given us the bullish signal that it's going up, but oftentimes in the morning session or in the morning bell, the market will go up, pull back down, break out all the highs, sweep out all the lows, and then start to go sideways and reestablish a new trend. You won't know whether it's bullish or bearish because look at the Russell. It's doing the exact opposite of the Nasdaq. So if we were to look at go long on this Nasdaq, we're getting a bearish signal right now. It's breaking below the VWAP, and it's also breaking below before the average true range. So I wanted to see that turn and start to rally and go back up. I don't want to see it. I want to see that reflection, that A, B, C, D reflection, right? Look at the Dow. It's still going up. So there's still some chance that this Nasdaq could go up. And if it does, we might want to take a long position in anticipation. Here's our ABC pattern. So here's what we're looking for. So here's our A, our B down here. We want to see it C. We want to see it break that previous high and continue to rally and come up and break into these 100 levels or 130 levels. That would be really nice, right? To see it go back up and make a nice reflection of the first run, the pullback, and then the second run. If that's the case, we'd drop an order in here to take a long position. And you'll notice that I'm trailing down one bar back. Oh, we just got a reversal right there. So it's now saying we're bearish. So we're taking a long position when it's saying it's bearish, but we might get that little ABC flip right here. There we go. And our goal when we trade is to make $500 a day, right? We just want to make $500 a day. So I'm going to come in here. I'm going to add an OCO in there. And the way I do that is I come in and I drop this in at $500. And I say, look, if the market goes up and hits me $500, I'm done for the day. I could do that in the first 15 minutes of the day. I can do it in the first 5 minutes of the day. but or it might take me 2 hours to make $500. I might take a loss, and then I'd have to recover my loss. Then I'd have to get in and try and make the money again. Hit another loss, have to recover the loss. And if this comes back, we don't want to really take any. We don't want to take a hit, so we're going to bring our stop right up there close. If it comes back and tries to stop us out, we'll just get out with a scratch trade. It needs to go immediately in our favor. I don't want it to come back and have to recover losses. I hate to have to recover losses. That's always a real pain. So where this market's already zoomed a little bit, it's going zoom on us here. Let's anticipate a continuation of the uptrend. But if it comes down and touches where we got in, our entry point, I don't want it to go negative on me. And of course, the problem with that is you get out at break even, it comes down, touches your break even, and then turns and takes off without you. And that's no fun either. But if it goes up and hits our $500 right now, we'll be done for the day. We'll have our money before the report even comes out. So we needed to break that previous high, pop up there, give us our $500. We're done. We've made, well, $465, but that's basically our $500 for the day. And that's a good income. And we've done that in the first 15 minutes of the day. So we're done trading if $500 is enough for you. If you want more, well, you can wait for another setup, look for another little ABC pattern, and continue to trade. But that's just the name of the game. It's really just that easy. Trading's not hard if the market's moving and trending and making the patterns. Where trading gets hard is where you try to trade when it's a dead market. Like yesterday. If you go back and watch yesterday's recording of our live session, then yesterday was a hard day. The market wasn't trending nice. It had a few trends, but it didn't have any follow through. It didn't have any ABC patterns. And that's what I like to trade. And so if the market's just making these, like, look at the Russell. The Russell went straight down, didn't make any ABC patterns, turned around, went straight back up. You're like, oh, that's an easy market to trade. No, that's a hard market to trade. Why? Because it's not giving us any ABC patterns. Okay, we need these little reflections. These little reversals are really hard. You don't know that the market's going to come down, reverse, and this turn and go right straight back up again. Of course, you never know what the market's going to do. But look at the Dow. This market come off the open. It went up. It pulled back, give us 2 bars. Didn't break below the ATR down there. Didn't give us a new low or a reversal, and then it turned and broke above the previous high. So you trail down behind the previous high with an auto trailing stop. We do that in track and trade with these QOCO buttons. I'll show you how I've got mine set up. Oh, I got a whole bunch of just some strategies in there. Over time, we'll go through all these different strategies that I got to put in here. But these are all user definable, and I've put those all in there. We're using strategy number 17 right here on this one today. So I'm going to come down to strategy 17. I got a big list here. Let's see, where's 17? There we go. So this is what it looks like. This is what my settings look like for strategy 17. You can see that it's got number 17. This, I just write this in here. So that's my information that I put in the title of this strategy. And it's just number 17, and it's the stop, trail, 1.1, price bars back. The stop is 0, and the limit is 0. So I've got zeros in my stop and limit. So there are no stops and limits. An OCO means that we have one cancels other, right? Or one triggers other, OTO. So these are OCO, OTO buttons, and you can pre-program them to do whatever you want. You can make the orders do anything you want. You can put limits, you can put stops, you can have the stops trail, you can have them trail to entry. You just tell it right here. So all you have to do is hit one button, and bam, it starts to auto trade for you based on that setting. It's kind of like an AI system that once you tell it how you want it to trade, it'll trade for you. It's not going to tell you how to trade. You're going to tell it how to trade. All you have to do is hit the button, and then it'll trade it for you, just how you trade it. It's told it. So in this case, I'm telling it to trail 1 price bar back, and I'm actually saying 1.1 price bar back. And the reason that is because we've got a spread. And the spread in here is on average right now, it's averaging 1, which is great. A 1 spread is amazing. That's really tight. So that's another reason why I really love the futures market, is because the spreads are really tight. So I put 1.1, so it's 1 price bar and 1 minimum move. 1 minimum move is one tick, which is the spread. And so I want it to be back behind that price bar 1 minimum move, so that if it comes down and touches the low, it doesn't pop me out, only to then take off and run again. So that 1.1 and the 1 at the end is to accommodate the spread. And then I have all this other stuff turned off. I have all the jump stops turned off. I have the trailing stops turned off because I'm not using a trailing stop, because I'm going to manage that myself with another auto trailing stop in the other direction if I want to do that, and I can use the quantities. So that was just the simplest of them all. It's just an auto trail. Look at this market go. Now you're looking at this saying, Lan, why'd you get out at $500? Well, because I like to set a risk and money management strategy where I'm like, okay, what's your goal for the day? Well, you can set a goal for $500. And then if you're like, well, you know what, we hit our goal in the first 15 minutes, maybe this is a good hot market, we can trade again and make another $500. Well, that's a decision you have to make. If you set your goal for $500 to make $500 a day trading, remember, day trading is for income replacement or for income to add to your income, right? A supplemental income. So we day trade for income, and we need to set a a profit limit. We need to set a loss limit. That's called risk and money management. You hear people say that all the time. Oh, risk and money management. What is risk and money management? Risk and money management is determining how much money you want to make that day, and you set that as a goal, and you work towards that goal. You also have to have a loss limit. So how much are you going to lose if if things go wrong and go against you? How much are you willing to lose? Because if you don't set a loss limit, you could just say, well, the loss limit is when I don't have any money left in my account. That's how we go to Las Vegas, right? We go to Las Vegas and we say, well, I'm going to take $500 in my pocket with me, and when that's gone, I'm going to stop gambling. Okay, well, you might have been up $2 grand, $3 grand, $4 grand, but you just kept gambling because you have $500 in your pocket, and you're not going to stop gambling until that $500 is gone. Well, eventually your $2,000 winnings go down all the way down to $500 loss, and you're like, oh, well, I just lost my $500. I guess I'll stop. That's what the casinos want you to do, because they want that $500 in your pocket. They don't want you to stop when you're ahead. So when it comes to trading, you need to use some of that same psychology. Not that gambling or trading is gambling, but very closely correlated, aren't they? To some degree, we have a strategy that we're going to play, and we're going to work that strategy out. And when we make our money, we want to walk away from the table and say, hey, look, I'm ahead. I'm going to take my money. Now, if you decide that the market's hot, the table's hot, and you want to play again, now go for another 500. But then you have to set a daily loss limit. Now, if that's going to be 500 still, you're going to lose. You're going to risk the full 500 you just made to try and make another 500, and that's okay. I would squeeze that down a little bit, and when you get a little bit more accomplished and you make a little bit more money, that can maybe your daily goal is going to be $1,000. I want to make $1,000 a day. I want to make $2,000 a day. I want to make $3,000 a day. And you can set your goals depending on the size of your account. And of course, we can talk about how big your position size should be, but in the beginning, you should only start off with one contract. Start small and be very careful and cautious and work towards achieving that goal. And so what I like to do is I like to try to achieve that goal. Once I achieve it, if I still feel like I want to trade some more, then I set another limit. So I say, okay, I'm going to try and go for $250 now. I made 500. My next goal is 250. That means my loss is going to be 250. That means if I lose 250, I still have 250 from the previous 500. Okay, so at that point, I have to stop trading and walk away. Don't come back and trade until maybe tomorrow. Okay, so we take our $250 today, we bank that, and we go and we try and make our $500 again tomorrow. If we want to try again and go up to 750, we go 750. Maybe we make the 750. Now we're going to try and make another $100, and we're going to risk another $100. But if we lose the $100, we're out, and we stop for the day, and we've taken still some of our profits away. So it's a process of building on top of what you're making so that you don't lose it all, setting your parameters and determining where those are at. And if you decide that you want to continue, well, set new parameters and continue. There's nothing wrong with that. Keep going. All right, if the markets are doing well. So now look at this market. We're going to come up and we're going to say, okay, the Nasdaq making a beautiful trend. It's made an ABC pattern. We're getting another drive up in here. So this is a nice set of bars. You can notice all the little flat bottoms. So we could have just, instead of setting our limit out there and taking the limit, you could have just trailed till exit. And yeah, it would have gone a lot farther. That's a different strategy. Goes beyond the amount of money that we needed, which is $500. We hit 465 actually. But nonetheless, we went up there, and you could say, well, If I was trading for a goal of $1,000, well, your $1,000 might have been still up here higher, and you'd have got stopped out with, let's say, 750. Well, okay, great. You made 750. Your goal's 1,000. You're still going to go for another 250. So you're going to wait for another setup and go for another 250. But you would have trailed that one all the way out till exit rather than taking it the limit, because the limit only gave us 500. Maybe the limit wouldn't give you quite the 1,000. So you get stopped out with the 750. Well, now you have another attempt to make the rest. You don't generally always make your full goal in the first rally or the first run or the first trade. You may maybe only make 100 or 200, and then you trade 2 or 3 more times to try and get back up there. If you lose a little bit, well, that's okay. You lose a little bit off. Let's say we made 500 and we try to trade and we lose $100 off. Well, we'll keep trading until we, you know, reach our goal one direction or the other. But let's say you get in, and the very first thing you do is you go red, and you're down $100. Oh, you hate that. The very first trade and you go red. Well, our goal is 500. We're down 100. The next trade, we don't go in and say, okay, now we have to make 600. That's not what we do. We go in and we now have to make 100. So our goal at that point changes. It changes from being 500, which would then be 600 to cover the 100 and then the 500 we want, down to just recovery. So then once we get red, we have to go into recovery mode. Now, a lot of traders you'll listen to, and they won't do that. They'll say, no, that's not how I trade. And a lot of traders won't set a limit. They won't set a walkaway point. They won't say, I've made my daily goal. I'm just going to trade until I feel happy. And then I guess that's when they walk away. You know, when is happy? I'm never happy. I never have enough money. So that's why traders end up never walking away, and they end up losing, you know, a large percentage of what they have. Now, a lot of traders will say, well, I'm going to make money until I lose 50% of the value. And that's part of what I say too, right? If we're going to make 500 and we're going to try again, well, our next loss value is 50% of that. So we're going to only lose 250, and then we got to walk away. So, you know, you can set this up however you want. But for me, I just outlined how I like to do it. And look, here's another little buy signal, not a very good one. So we got one little bar back, spiked our yellow dots, our average true range. Yesterday I had those as a line. Today I switched them as a dots. I think it's a little easier for you to see. And you can trail on these dots too. I was trailing price bars back. You can set it just to follow the yellow dots. So if you want it just to trail the yellow dots, the software, you just say, I want to trail on the ATR, and it'll trail up on those ATRs for you. It'll just do it all for you. You don't have to move it yourself. Once you set it and tell it what you want to do, it'll trail on just about anything we've got in here. The blue lights, the ATR, the parabolic SAR, there's a million indicators in here, and you can trail on all kinds of different things. You can trail ticks back, dollars back, cents back, all kinds of stuff, whatever your strategy is. For me, I like dollars back, and I like to trail on these yellow dots. Now, we're just looking at all 4 markets right now simultaneously. Sometimes I like to focus in. We got 5 minutes till the report comes out. I'm going to stay with you here until the report comes out. I want to see what the market does during the report, but we can come in here and I'll show you. I've got it in my charts section. I've got a bunch of portfolios set up, and usually what I'll do is I'll pick one of the markets. I'll say, okay, which one seems to be trending the best and making the best trends? It looks like it's the Russell. So we can come down here and we'll just go to mini Russell. And I got this set up so that it'll just pull up the 2 mini Russells, and I want it to be side by side instead of over. So I'm going to switch them like that. Okay, so now I've got the 2-minute Russell over here on the left side, and I've got the 1-minute Russell over here on the right side. And when I get a longer term chart, I like to use the bulls and bears. The bulls and bears is a proprietary indicator that we have in the software that tells us when the market's bullish, bearish, and neutral. It's also tied into Fibonacci and Elliott Wave. If you're not familiar with that, I've got lots of videos here in my channel where you can go back and look for the bulls and bears, and it shows you, we've got lessons on how to do the bulls and bears. You can go to my website, lanturner.com. Of course, let's see if we got a banner in here for that. Maybe I got a banner in here. Maybe I don't. Some good information on lanturner.com. Here's at least, here's my link tree. We'll throw that in there. The link tree. So you can go to my link tree, and that's got a few links in there that you can get off and get some free information. Find out more information about me. Go to my website, lanturner.com, where we got some education, or you can go to the videos, the historical videos here on Trade Mentors on YouTube. And you'll be able to see some videos that I've done about the blue light system, about the bulls and bears, how that works, how Fibonacci Elliott Wave works. And so those are important things for us to know. And that indicator that's over there on the 2-minute chart is the bulls and bears indicator. Now it needs a little bit more data to work. So, when it's first thing in the morning, you can take a look at the bulls and bears. But for the most part, I look without the bulls and bears on the 1-minute chart, with the bulls and bears on the 2-minute chart. Then we can see the overall Fibonacci trend and how that's working for us. I've also got the CMF. Again, I'm not going to go into great detail on that indicator. There's other videos that I've got, and we've talked about it in the past. If you want a little bit more information about that, you can always send me an email, LHTurner, as in Lan H. Turner, LHTurner at gmail.com, or actually better not do that one because I probably won't see it. That's my junk email. Go to LHTurner at tradementors.com. LHTurner at tradementors.com. That email will come to me, and I can send you a cheat sheet. I've got a cheat sheet that will give you some more information about how to trade some of these different indicators, like the CMF, the Russell 2000 has the bulls and bears, and so I can show you a little bit about the bulls and bears, some of that stuff. I've also got videos on my course material, of course, on my website, lanturner.com, that you can sign up for, learn a little bit more about what we're doing here. But come and join me in these sessions and these meetings, and we'll watch the markets. We got this reports getting ready to fire off here in just a minute. 7:57 and 14 seconds. So 57, 58, 59, 60 minus 10. We got 2 minutes. 2 minutes to the bell, or 2 minutes until the report comes out. And it's interesting to watch the markets, because this one here, as I pointed out before, is a red. I think I closed it. I did close it. Go pull it back up again. Oh, no, here it is. I didn't close it. There we go. So this is the report we're watching, the JOLTS job opening. All right. So the number of job openings fell by 34,000 from a month earlier. This is the last one. So this is one we're getting replaced. So these are the job openings. So from July 2022 down to April 2023. So we're going into 9582 job openings. So we got very few job openings. We're going to see if that increases or decreases over time. So that's what we're looking for. So we'll watch the markets. You can see them going sideways right now. They're like, what's going to happen? Everybody's waiting. Everybody's waiting. I don't want to cover up the market, but this is the, so 8 o'clock. This will refresh right as soon as they give us the numbers. So that's what we're waiting for. You can see it getting ready to refresh. Let's kind of push this over here a little bit, see if we can watch the market at the same time. There we go. So this is the, actually what we want to do is we want to go back over. Let's go watch all of them. So we're going to come in, we'll go to charts, and let's go to the 1 minute. We'll watch all 4 markets. There's a better way to see that. Let's see them this way. This way. Bring them all in. There we go. Okay, here's our report. There's our bell. Okay, there's the numbers. 8827, 9 points, so down. So it was 9.165. It's now, get out of the way. It's now 8.872. So that's even better news. So that's good news. So watch the markets go long. Here we go. Watch them go. Broke this into the upside. Look at that. Right there's your trend line. That thing, if we'd have been trailing down, anticipation of a continuation of the rally. So this is all because of the good news of that report right there. Sometimes you're like, wow, why did the market take off and go to the moon like that? I wasn't ready for that. Why did it do that? What made the market go and do that? Well, that's because of these job reports that come out and these different types of government reports. And so you can see that here. And the software I use, or the little website I use to track that, is called tradingeconomics.com calendar. And then you can come in here and you can set that all up. There's all kinds of different impact. What impact do you want to see? This is the 3 impacts, just the red ones. These are the market movers. So you can see tomorrow, actually this is Thursday, We got one core PCE price index coming in here. Let me move this over so we can watch the market at the same time. So we're going to come over here and see that on Thursday, we've got at 6:30 a.m., we got the core PCE, we got personal income, and we got personal spending. Those are all at 6:30 in the morning, and those are going to be firing off. They'll affect the market. They'll make them run because they're red. On Friday, we've got non-farm payroll. That's a big one. That one will move the market. U.S. unemployment rate. That's another big one's going to move the market. The manufacturing PMI. Well, these are all red. That's why they're big ones. They're all going to move the market. That's all on Friday. The manufacturing PMI is at 8 a.m. So that's after the market opens. These others are before the market opens. So you could get up at 6:30 if you want to and trade those in the futures market because the futures market is open, right? So you might want to do that. But otherwise, we wait for them to trade during the market day. Now we can come and see a little bit less impact. We go a little bit lower impact, and we can see today we had some, at 7 o'clock, we had some lower impacts, but they're still bold. When we come into the one impact, you can see that these are all the reports that come out. And some of these will move the markets, a little bit. They'll kind of give a bullish, bearish momentum to the market. And you can trade these different reports as you watch those things come out and watch the market move. If it's bullish, the market generally goes up, right? If it's bearish, sometimes the market will whip around a little bit if the market's not sure which direction before it finally decides which direction to go. But that's watching the market, and that's how we do that with these reports, these government reports. So that was fun to watch. We could have been trading that one if we want to, but it's bullish. So now we're going to have a bullish emphasis to the day. Right? So now there's a little flag. So this is called flagging. So the market is flagging right here. And so that's where we're getting a little pullback. See how the highs are lower, highs are lower, lower highs, but higher lows, higher lows, higher lows. Higher lows and lower highs. We're coming into this is called a pennant formation. Now, because we got bullish sentiment to the market, we would expect the market to break out the top of this little flag and continue to rally. So that's a pennant. Lots of people love to trade pennants. We got one over here on the S&P 500. You can see it breaking down right here and breaking up right here. So that's a pennant formation, and a lot of people like to trade those. We would expect, because of the report being bullish, that the market should bounce out the top of this thing. Now, it may not. It may take this thing down, because remember, during these reports, sometimes people see it as negative. Sometimes it's not good enough. It comes out as a positive number, but they were anticipating that it was a higher number. So the first anticipation might be, hey, this thing's positive, it's going, and then everybody's like, wait a second, it should have been higher. So yeah, it was high, but it wasn't what we thought it was going to be. So what was thought to be was built into the market price, and then the initial excitement of it being bullish, but then they're like, wait a second, it wasn't as good as we thought it was going to be, and then the market flushes. So you can get a flush on a positive report, and that's why. It's because it just wasn't as good as they thought it was going to be. So the markets are, we call them futures because it's a future price of what we anticipate the market being right in the future. That's why it's speculation of future price. That's primarily with the indexes. You get into the individual commodities, then those are the price that things are right now, right? They're actually the futures. We call them the futures because the products are delivered in the future, but you can buy them today and have them delivered to you in the future. That's why we can trade them as speculators, is because we can buy and sell them today, but we don't have to make delivery or take delivery until sometime in the future. And because of that, well, if we buy it today, that means that I have to take delivery sometime in the future. But if I don't want to take delivery, I just have to sell it before the future, right? Before the delivery date. That's how it works. So you can buy and sell, buy and sell, buy and sell all you want. But then when it comes to the delivery date, or the, whether you're going to take delivery or whether you're going to make delivery, depending on whether you bought it or sold it, you just have to offset your position. Say, well, I bought corn. Well, I don't really have any desire to take the corn in. I don't want to have it delivered to me. So before the delivery date, then you have to sell your corn, get rid of it, so you don't get delivered. And you just have to offset your side. So you can buy it and sell it all you want because there's a delivery date in the future. That's how futures works. That's why we call them futures, and that's how commodity trading works. It's the same thing here in the indexes. Excuse me. Talking too much. My voice is starting to run out. All right, here's our little pennant. It's broke to the upside. We would expect it to come up and break this previous high, hold above that high. We want it to hold that price and continue higher. Otherwise, it's going to fail. If it fails, we would expect it to turn and come back down and maybe test one of these previous lows. But we're going to anticipate that this thing's going to continue to break higher on the good news. We're getting a little slow down here. That's a little nervous. See, the volume is starting to drop. We should be getting increasing volume to see this thing break out the top, and we're not. We're getting lower volume. So it's getting a little scared. Look, the Russell is already dropping. So the Russell is saying no, no can do, not going any higher. So that's your leader right there. That's signaling that, hey, something's not right here. But notice how they are all trend pretty closely to the same. Now, sometimes you get one that goes off and goes weird, like yesterday. Yesterday was a hard day to trade because none of them were synced. They weren't all doing the same thing. They were doing different things, and it made it really hard to trade. We ended up with basically a scratch trade yesterday. We just had several trades, and we had to just recover our losses. Once we got back to green, we cut it and said, that's enough. This market's too hard to trade. And that happens sometimes. Markets aren't always great to trade. Sometimes you just have to sit and wait for the perfect setup. And that's the key. You don't have to always be trading. You sit for some time. I mean, you're going to make $500 in a few minutes, right? You might have to wait for 2 or 3 hours for that right setup to come in that makes you feel comfortable and confident so that you can make that $500. Oh, darn. Took me 2 hours to make $500. That's $250 an hour. You don't have to be trading during that $250 an hour. You just have to be present, watching, active, ready, waiting for the perfect right setup to take it. And and then of course there's still no guarantees, but there's no reason to push your luck when you're trading. You just wait for the right setup, and if the setup doesn't come along, fine, we'll come back and we'll do it again tomorrow. So be very cautious, very careful. The name of the game in trading is not making money, it's not losing money. That's the key. The key to trading is not losing money. Now, everybody's going to take a loss. Everybody's going to lose a little bit of money. That's the name of the game. You're always going to have some losses. You just have to have your winners have to outpace your losses. And so you have to work to do that recovery. Like I said, that's the way I like to do it. I like to recover and then start to work to make the money. A lot of guys say ignore the loss and just trade for the trend and go as long as it wants to give you money. Different strokes for different folks. All right. You have to pick the direction and the way you want to do it. All right, guys, that's it. We've made our $500, close enough today, and we're going to cut this live stream short right now and let you guys go get your software and start watching the markets and do this for yourself. And we'll try and meet back here again tomorrow. We'll do it again. Meet me here in the morning. Now, I can't guarantee that I'm going to be doing these every single day, so make sure that you subscribe to the channel and make sure you hit the little bell. The little bell lets you know when I'm coming live. If you don't have the little bell ding, then I'll come live. You won't know it. So you need to hit the little bell, subscribe to the channel so you don't lose this channel, and then hit the bell so you get notified when I come live. And then we can work together. It's fun. And then make sure you leave some chats. Make sure you please, if you want for me, hit the like button if you like this video. Hit the little thumbs up because that tells the algorithm that it's a good that you enjoyed it and that it should show this to other people, and we'll get some more people in our group here. And also leave a comment. If you leave a comment, again, the comment really helps out the Google algorithm. They look at that and say, oh, somebody commented, this must be a good video. So leave a comment and that'll help us get more people in our group too. And if more people we get in the group, the more likely I am to come and do these. If we don't get anybody watching, then there's no point of coming. So if you can help me build this group up, we'll do this more often. All right. Look at the market fall. Look at it fall. It just broke those yellow lights at average true range to the downside. It went red. That would have been a nice place to take a short position. Of course, now look at the Russell, which has been the leader. It's starting to rally off of that red bar. So it pulled back, gave us that little pullback, little flag once again, and it started to rally. But look at this one here, that Dow and the S&P starting to fall. Those would be good signals to take short positions on reversals. Look for it to come back down, bounce off of that VWAP. It's the rubber band, and that distance between that red bar and down to the VWAP would be your target point, and away we'd go. All right, guys, I'm going to let you go. We'll catch you next time.